Welcome back. Given the rather slow news day on the economic calendar, I thought it might be helpful to address a couple really good questions that we've received on our YouTube channel as of late. One is about the behavior of the long and short-term bond markets in 2020 and what that implies to today's markets. But the other is in regards to the Federal Reserve. Sort of take it for granted that everybody, has a very in-depth understanding of the Federal Reserve. But just to refresh your memory, the Federal Reserve monitors financial system risks to ensure the system in order to achieve a healthy economy. It has a number of core responsibilities, including setting interest rates, managing money supply, regulating the financial markets. It's managed by the Board of Governors, located in Washington, D.C., and it's run by 7 Federal Reserve governors. They meet every 6 weeks in order to determine interest rates. The Federal Reserve, among other duties, also distributes currency, coins, lends money to banks, processes electronic payments, etc. There are 3 primary functions of the Federal Reserve that we talk about when we talk about interest rate decisions: maximum employment, stable prices, monitoring long-term interest rates. Those are the 3 elements, and that's what the Federal Reserve watches in their decision to raise or lower interest rates, and that is why we watch economic calendar under that light so carefully. Now, this is also called the dual mandate. We grabbed this right from Investopedia. Congress explicitly stated the Fed's goal should be to maximum employment, stable prices, monitor long-term interest rates. So again, we look at non-farm payrolls, the other employment figures. We want to see that maximized. We want stable prices. We don't want bubbles, stock market bubbles, bond bubbles, etc., because that's not good for the economy. And moderate long-term interest rates. They should not be too high to suppress growth, but they should also be not too low to invite inflation. Now, taking a look at the effect of the Federal Reserve and their interest rate decisions, we go back to 2018, 2019. We had the blue area chart in the background. That's a federal funds rate. That's around 2.5%. The red line is the S&P 500. And we started to see the Federal Reserve reduce interest rates even while the S&P 500 went up. Now, we had a question last week that was really good. Why is it that if the Federal Reserve is cutting interest rates, why are stocks going up even more? There's 2 sides to the coin. Why is the Federal Reserve cutting interest rates? Well, it was at that point, 2019. It's because they see weakness on the horizon, and they want to let up on the pressure to the economy, loosen monetary policy. When they lower interest rates, it makes it easier, less expensive to invest, to buy homes, invest in businesses, things of that nature. But in the short term, that's a positive for stocks. Well, in the long term, of course, it's a positive for stocks. We could ask, well, why is the Federal Reserve cutting interest rates? They see troubled waters. But then that's weighed against the fact that, hey, they're cutting interest rates. That's good for stocks. Now, we take a look at the Federal Reserve and the stock market present day. We know they left rates unchanged at 5.25%, their last decision. We see the Federal Reserve has raised interest rates from the 3% up to, again, 5.25% from September 22 through present day. The red line is the S&P 500. It continues to rally higher. This is the federal funds decisions as they affect the bond markets. We have here the Federal Reserve interest rate decisions, the blue area charts, the interest rates. The red line is a 10-year Treasury. The black line is a 1-year Treasury. As the Fed started correction, before the Federal Reserve started to cut interest rates, the bond market already turned to the downside. And it's really important to note that if we just wait for the Federal Reserve to make their decision, we may find ourselves late to the game in terms of the market. If we look back to February 2019, we say, well, I wonder if the Federal Reserve is going to cut interest rates. Here they just pause this long flat top from December 18 through June 19. They didn't touch interest rates. But in that period of time, the 10-year Treasury fell from 2.5 down to about 1.75, 1.8%. The black line, the 1-year Treasury, fell from around 2.25, 2.5, down to the 1.5% area. So the bond market was already forecasting the Federal Reserve to lower interest rates. The bond market moves ahead of interest rates and the Federal Reserve decisions. Now, this is the federal funds and the bond market present day. The red line, again, are the 1-year U.S. Treasuries. The 10-year is a black line. That's a 10-year Treasury. Now, you'll notice we have an inverted bond yield curve, again, because the 1-year Treasury, the short-term maturity, is above the long-term. And what this is telling us is that in the short term, we expect higher interest rates. The short-term maturity bond, or Treasury bond, moves in a more reactive fashion in anticipation of higher, lower interest rates than the 10-year, the long-term Treasury. Now, this acts as an excellent segue to get us to our second question. Thank you very much for posting these questions. It really, I think, can be very helpful. This is a chart from 2018 through present day. The blue area charts a federal funds rate. The 1-year Treasury is the black line. The 10-year Treasury is the red line. The question was, you go back to August 2020. I'm paraphrasing the question. But you go back to around August 2020, the black line, the 1-year Treasury, the question was actually in regards to the 2-year, but 1 and 2-year, they behave in a very similar fashion. Why did the 1-year stay so low when the 10-year Treasury went up? Wouldn't we expect, now I'm kind of paraphrasing here, but wouldn't we expect the short-term maturity Treasury like the 1-year to move ahead of the 10-year? Well, we just said it's more reactive to the anticipation of short-term interest rates, Federal Reserve interest rate decisions. Well, that is true. That's exactly what we see here. The blue area chart, those are interest rates. When we see, and this is really something, we're going to look forward to in the next, what I would call true bull market. I don't think we're in a true bull market right now because the bond market's inverted. A true bull market occurs when stocks go up a lot with very low interest rates. Interest rates remain from April 2020 through April 2022, roughly, very close to zero. With interest rates so low, bonds, they weren't paying any amount of yield at all, nothing attractive at all. Certificates of deposit, any sort of fixed income security, there was nothing to be made on those. But if you want to borrow money to invest in the stock market, if you want to borrow money to buy a house, to invest in a business, anything of that nature, we're borrowing money at nearly 0% interest. It's all upside. And that's why the stock market led on to such a strong rally. Now, with that said, the 1-year Treasury is as close as possible to the Federal Reserve interest rates. Think of the Federal Reserve interest rate like a 1-day bond. Now, the 1-year Treasury will move up in anticipation of interest rates in the near-term future, let's say in the next year. The 10-year Treasury will move up or down in anticipation of interest rates in the long term, let's say in the next 10 years. But the Federal Reserve, the interest rates, the federal funds rate that we call it, that won't change unless the Federal Reserve changes interest rates. So as long as the Federal Reserve doesn't change interest rates tomorrow, it's going to be at exactly where it is right now. And that's why the 1-year Treasury, to answer your question, the 1-year and also the 2-year stayed so low when the 10-year Treasury went up, because the 10-year Treasury was anticipating stronger economic climates. All of this investment, we're borrowing money near zero, and we're buying homes. Real estate market goes up. We're investing in businesses. Businesses do better. There's more hiring. Salary goes up. The job market's stronger. As a result, the expectation for not higher interest rates, I should say, but stronger economic growth improves. And to answer your question, that's why the 10-year Treasury went up, because it went up anticipating a stronger long-term economy. Now, eventually, the Federal Reserve started to raise interest rates. The blue area charts started to go up. And that's when, that's not when the 10-year or 1-year Treasury went up. The 1-year Treasury, the market is a forward-looking mechanism. The 1-year Treasury over here was guessing. Let's say maybe January. We'd have to look at a short-term chart to get the exact date, but let's say February, maybe January of 2022. That's when the one-year Treasury broke out. Yeah, around January 2022. The one-year Treasury broke out. Federal Reserve didn't raise interest rates till around April or so. But that's why it broke out. It was anticipating this blue step ladder to start to go up. Now, something very important happened right around this period of time, June 2022. We talk about June all the time. That's the beginning of the inverted bond markets. The inverted bond market, if you consider it under this light, occurs when the short-term expectation is even better than the long-term expectation. The economy is so strong, it's like we're expecting to go to a really good party. But at one point, the expectation, the short-term expectation is that the party is going to be so good that when we actually get there, it's a little bit of a disappointment. That's the beginning of the inverted bond markets, when the short-term expectation exceeds the long-term reality. Now, the inverted bond market doesn't mean that we're going to, the party's over today, so to speak, but it is a warning sign. When our expectations get better than reality, that's when we start to see an economy that begins to falter. So I hope that was helpful in terms of addressing that question. Great question again, both of them. 1-year Treasury, 2-year Treasury, they're going to move as close as possible to short-term interest rates. In other words, federal funds rate. The long-term Treasury will be less reactive to the short-term movements and influences, more receptive, more reactive to the long-term outlook. Now, while we're on the subject, we might as well take a look at current treasuries. This is where we stand. This is today's change in terms of basis points. 3-month was up 9 basis points. 2 years down 6 basis points. Kind of a flat day to day. Bond market's actually kind of fallen asleep over the past, I'd say, a couple weeks or so. This is where we sit in terms of U.S. treasuries. 1 month is at a 5.17. 2-month 5.31. We're getting the best yield here in the 3-month, 4-month, and 5-month. 5.50, 5.44, 5.45. This tells us the anticipation is that in the near-term future we may see higher interest rates. Long-term outlook much more bleak. The 10 years at a 3.72. This is the 1 month change in bonds. This is where the money has moved over the past month. The biggest movement, of course, 1 month treasuries down 14% in terms of yields. That's telling us that over the past month, the expectation is that, yes, we're expecting maybe the Federal Reserve to raise interest rates again, but overall, that expectation, relatively speaking, has really started to cool. This is where we are. The black dotted line is a 1 month. The purple dotted line, that's the 1 year. The yellow dotted line, that is the 6 month. The red solid line is a 4 month. So we have here, in the purple, that's the 3 month. We have the 3 month, the 4 month, the, again, 2 month, 1 year, 1 month. The very short term U.S. treasuries pay the most amount of yield. The longer term, like the red dotted line at the bottom, that's the 10-year. The solid white line, that's the 30-year. By the way, these histogram bars in the background, that's the S&P 500. Now, what's the message here? Actually, let's go to a chart. That'll better explain what's going on here. The 1 year is a red line. The purple line is a 10-year. Black line's 1 month. We put them 1 month also. The 1 month tends to lead the 1 year. Remember, the 1 month is shorter than the 1 year, so the 1 month is closer to Federal Reserve interest rate decisions. The 1 month is really reactive. What it's telling us is that big picture, the 1 year, 1 month is still very much above the 10-year. Meaning the anticipation of higher interest rates exists more in our near-term future. But over the long term, we're expecting lower interest rates on the 10-year. Well, the 10-year is telling us expectation of lower interest rates. So that's really the dichotomy here. And at the moment, the S&P 500 has been strong. I know it's pulled off of highs, but it's still, relatively speaking, it's still quite strong. because the Federal Reserve, I think in part, paused for one meeting. They said we're going to keep interest rates where we are. And a lot of the economic numbers really point to stronger conditions. Of course, last week we talked about the housing market, existing sales price for homes year over year, May to May, dropped, I think, the most since 2011. So there are certain parts of the economy that don't look so hot. But overall, I think the Federal Reserve still sees inflation as an issue. And again, remember, the Federal Reserve has what they call the dual mandate: stable prices, maximum employment, and long-term moderate interest rates. So taking all that into consideration, this is where we are, and this is where the Federal Reserve has left us for the time being. It's anticipated they may raise rates again, but we're going to watch the economic calendar very closely, and even more importantly, watch the bond market, how it reacts, specifically the short term. If we see any economic XYZ economic numbers released, watch the 1 month, watch the 1 year. If they start to go down, I think that's the anticipation that the Fed may not raise interest rates. If we see the short-term securities move higher, well, the signal is those are strong numbers, inflation is on the rise, and the Federal Reserve may not be done raising rates yet. So we hope this has been helpful. We truly thank you for the questions. Please keep them coming, and we'll be sure to update you along the way with any significant updates as well. We hope this has been helpful. We look forward to seeing you back soon.